Thanks for clicking. With the Bank of Canada set to raise interest rates on September 6th, there is a growing concern that those Canadians with variable rate mortgages and static payments are about to hit their trigger rate, or the point at which they have to renegotiate their mortgages with the banks. While the trigger rate is different for each bank, it usually comes when the interest portion rises to such a level that the regular monthly payment is no longer enough to cover the interest that is due each month. When that happens, the options vary, though the banks usually require that you either put down a lump sum payment, increase your regular payment, or increase your amortization schedule.
And frankly, you should be very happy I'm not going to tax you.
In this week, three of Canada's biggest banks, TD, CIBC, and RBC, addressed the looming trigger rates, going over each of their processes and what consumers can expect going forward. So what I want to do today is briefly go over what the trigger rate is and how it works, then look at what TD, CIBC, and RBC plan to do when their trigger rates are breached, and then discuss what to look for next. It's the end of the month, so we are eagerly awaiting the release of real estate data from Canada's local real estate boards, which is highly expected to show continual price declines across the board. We'll obviously have updates out on that data on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into these trigger rates. The trigger rate concerns those with variable mortgages and static payments. When you have a static payment, your payment doesn't rise as prime rises, but when prime does rise, the total portion of your payment that goes towards principal shrinks, and the total portion that goes towards interest rises. And the trigger rate comes when prime rises to such an extent that the mortgage payment that you have is not enough to cover the interest that is due. Let's take a brief look at the following example of a home buyer that took out a mortgage in January of 2022 for $585,000 when prime was still 2.45. In that example, the buyer had a monthly payment of $2,005 with about $1,300 going towards principal and about $700 going towards interest. However, prime has since risen to 4.7% as of this month. And now if we look at the amount that they're paying, that same $2,000 monthly payment would have $1,800 going towards interest and only $200 going towards principal. If prime rises again to, say, 5.2%, another 50 basis points at the next meeting of the Bank of Canada next month, that $2,000 payment will be short $43 and the trigger rate will be breached, and the bank will call to renegotiate the loan, as that $2,000 payment is no longer enough to cover the interest.
Have you got my money?
And given that Canadians are continuing to deal with ultra-high inflation, an increase in mortgage rates or a call from the bank is not exactly what the doctor ordered. So what do these big banks plan on doing? What will happen once those trigger rates are breached? First up, TD. Michael Rhodes, head of TD's personal banking division, says that if a TD customer hits their trigger point, the point at which the principal is no longer being paid down, TD will reach out with a number of options. Of those options, Rhodes says TD allows consumers to make lump sum payments, allows them to increase their current payment to ensure it does cover the principal and interest, and allows them to do nothing. If they do nothing, then the amortization will be off the original schedule, meaning at the time of renewal, buyers will have to increase their amortization period, or the amount of time that they have available to pay off the mortgage. So TD is giving a number of options: lump sum payments, increase the amount of payments, or extend the amortization at the time of renewal. CIBC, on the other hand, leans more towards extending the amortization. When prime rises, CIBC defaults to extending the amortization during the term of the mortgage. However, at the time of renewal, CIBC switches to the original amortization schedule, which, if prime has been rising throughout the term, will lead to higher payments. So, in its most basic form, if you started out on a 25-year amortization with CIBC, and then at year 2 your trigger rate was hit, they would extend the amortization to 30 years to ensure that at least a portion of your mortgage payment was going towards interest. However, at the time of renewal, your amortization would go back to 20 years where it should have been if that trigger rate wasn't hit, and as such, your payments will go up at that time of renewal.
It's time to refill the tank.
RBC, on the other hand, says that the vast majority of its mortgage portfolio are fixed-rate mortgages. With that said, RBC announced this week that it does expect about 80,000 of its clients to hit their trigger rate this year, those clients that have variable rate mortgages with static payments. Unlike TD and CIBC, once that trigger rate is hit, RBC will adjust the payment, which RBC estimates will average out to about $200 per customer. So in summary, when that trigger rate is hit, TD is likely to reach out and offer a number of options, including lump sum payments, increasing the monthly payment, etc. On the other hand, CIBC defaults to extend the amortization, with the higher monthly payments not coming until renewal. And then finally, RBC will be adjusting the payment once that trigger rate is hit, adjusting the payment so that at least some portion of that static payment does go towards interest. Well, CIBC says that they have already been reaching out to clients to discuss options, and RBC says that only about 0.5% of their clients will require a phone call. The best moves going forward if you have a variable rate mortgage and a static payment is to give your lender a phone call. Be proactive to find out, 1, when your trigger rate will hit, and 2, what your options are. I can say from experience that a lot of mortgage lenders do not adequately address what the trigger rate is or when it will be breached at the time of the signing of the mortgage documents. So I can't stress enough, it's important to be proactive with them, to give them a call, just in case something gets missed in the shuffle and they fail to call you. It's always best to be ahead of the game. I did do some additional research to try to find out the trigger points for Scotiabank and BMO, the other two big banks in Canada, but they don't have it listed publicly on their website, or at least I was unable to find it. If they do have any announcements coming out, like the other three banks regarding their trigger points, we'll definitely have an update out on those on this channel. If you want to get those updates, make sure you click like and subscribe, but for now, thanks so much for watching.